Welcome back, everyone, to Data Science for Everyone. Today we're going to be looking at
the Federal Reserve banking system and central banks. Central bank, the organization responsible for conducting monetary policy and ensuring that the nation's financial system operates smoothly. In the U.S., the central bank is the Federal Reserve, or the Fed. It's a semi-decentralized mixing government appointees with representation from private sector banks. It's run by a board of governors consisting of 7 members appointed by the President of the United States and confirmed by the Senate. The 12 Federal Reserve districts. The Federal Reserve is more than a board of governors. The Fed also includes 12 regional Federal Reserve banks, each of which is responsible for supporting the commercial banks and economy generally in its district. What does a central bank do? The Federal Reserve is designed to perform 3 important functions. 1, to conduct monetary policy. 2, to promote stability of the financial system. 3, to provide banking services to commercial banks and other depository institutions, and to provide banking services to the federal government. Bank regulation is intended to maintain bank solvency by avoiding excessive risk. Regulation falls into a number of categories: reserve requirements, capital requirements, and restrictions on types of investments banks may make. Regulation requires that banks maintain a minimum net worth, usually expressed as a percent of their assets, to protect their depositors and their creditors. Bank supervision. Several government agencies monitor banks' balance sheets to make sure that they have a positive net worth and are not taking too much high of a risk. A bank run is when depositors race to the bank to withdraw their deposits for fear that otherwise they would be lost. Bank runs during the Great Depression only served to worsen the economic situation. Deposit insurance and lender of last resort. The risk of bank runs can create instability in the banking system. To protect against bank runs, Congress has put 2 strategies into place. Deposit insurance, an insurance system that makes sure that depositors in a bank do not lose their money even if the bank goes bankrupt. Banks pay an insurance premium to the Federal Deposit Insurance Corporation, or FDIC. Lender of last resort, an institution that provides short-term emergency loans in conditions of financial crisis. How the central bank executes monetary policy. Federal Reserve's most important function is to create and conduct the nation's monetary policy. Monetary policy involves managing interest rates and credit conditions, which influences the level of economic activity. The most common monetary tools in the U.S. are open market operations, the central bank selling and buying treasury bonds to influence the quantity of money and the level of interest rates. The Federal Open Market Committee, FOMC, makes the decisions regarding open market operations and is comprised of 7 members of the Federal Reserve Board of Governors and 5 voting members of the regional Federal Reserve banks. How open market operations increase the money supply. Table A shows Happy Bank starts with $460 million in assets divided among reserves, bonds, and loans, and $400 million in liabilities, in which the form of deposits, with a net worth of $60 million. Table B shows that the central bank purchases $200 million in bonds from Happy Bank, and the bank holdings of Happy Bank fall by $20 million, and the bank's reserves raise by $20 million. However, Happy Bank only wants to hold $40 million in reserves, the quantity of reserves with which it started. So, Table C shows that the bank loans out an extra $20 million in reserves, and its loans rise by $20 million. The central bank's open market operation causes an expansion of the money supply. How open market operations decrease the money supply. Table A shows that the balance sheet of Happy Bank before the central bank sells bonds in the open market. Table B shows that Happy Bank purchases $30 million in bonds. Happy Bank sends $30 million of its reserves to the central bank, but now holds an additional $30 million in bonds. However, Table C shows that the Happy Bank wants to hold $40 million in reserves, so it will adjust down the quantity of its loans by $30 million to bring its reserves back to the desired level. A bank can easily reduce its quantity of loans by slowing down or briefly stopping to make new loans. This operation causes the money supply to decrease. Changing reserve requirements. A second method for conducting monetary policy is for the central bank to raise or lower the reserve requirement. The reserve requirement is the percentage of each company or each bank's deposits that is legally required to hold either as cash in their vault or on the deposit with the central bank. Greater reserve requirement is equal to less money available to lend out. A smaller reserve requirement equals the greater amount of money available to lend out. In practice, the Fed rarely uses large changes in reserve requirements to execute monetary policy. Changing the discount rate. Third traditional method for conducting monetary policy is to lower or raise the discount rate. The discount rate is the interest rate charged by central bank on loans that it gives to other commercial banks. If the central bank raises the discount rate, then commercial banks will reduce their borrowing of reserves from the Fed and instead call in loans to replace those reserves. Since fewer loans are available, the money supply falls and market interest rates rise. If the central bank lowers the discount rate it charges to banks, the process works in reverse. Monetary policy and economic outcomes. Expansionary monetary policy or loose monetary policy is a policy that increases the supply of money and quantity of loans. Contractionary monetary policy or tight monetary policy is a policy that reduces the supply of money and loans. The effect of monetary policy on interest rates. The federal funds rate, the interest rate at which one bank tends to that lends funds to another bank overnight. How does the central bank raise interest rates? It does this through open market operations. The central bank changes bank reserves in a way in which affects the supply curve of loanable funds. The Federal Reserve has, since 1995, established a target federal funds rate in advance of any market operation. If open market operations do not meet the Fed's target, the Fed can supply more or less reserves until interest rates do. Monetary policy and interest rates. The original equilibrium occurs at E0. An expansionary monetary policy will shift the supply of loanable funds to the right of the original supply curve S0, to the new supply curve S1, and to a new equilibrium of S1, reducing the interest rates from 8% to 6%. A contractionary monetary policy will shift the supply of loanable funds to the left from the original supply curve S0 to the new supply S2 and raise the interest rates from 8% to 10%. The effect of monetary policy on aggregate demand. Monetary policy affects interest rates and the available quantity of loanable funds, which in turn affects several components of aggregate demand. Tight or contractionary monetary policy will reduce two components of aggregate demand. Business investment declines since it is less attractive for firms to borrow money. Consumer borrowing for big ticket items. Conversely, looser expansionary monetary policy will tend to increase business investment and consumer borrowing for big ticket items. Expansionary or contractionary monetary policy. In Figure A, the economy is originally in recession with an equilibrium output and price shown at E0. Expansionary monetary policy will reduce interest rates and shift aggregate demand to the right from aggregate demand naught to aggregate demand 1. This leads to the new equilibrium E1 at the potential GDP level of output with a relatively small rise in the price level. In Figure B, the economy is originally producing above potential GDP levels of output at an equilibrium of E0 and is experiencing pressures for the inflationary rise in the price level. Contractionary monetary policy will shift aggregate demand to the left from aggregate demand naught to aggregate demand 1. This leads to a new equilibrium, E1, at the potential GDP level of output. Monetary policy should be countercyclical. Countercyclical moves in an opposite direction of the business cycle of economic downturns and upswings. The pathways of monetary policy. For figure A, in expansionary monetary policy, the central bank causes the supply of money and loanable funds, M, to increase, which lowers the interest rate, R, stimulating additional borrowing for investment, I, and consumption, C, and shifting aggregate demand, right. The result is a higher price level and, at least in the short run, higher real GDP. For figure B, in contractionary monetary policy, the central bank causes the supply of money, M, and the credit of the economy to decrease, which raises the interest rates, R, discouraging borrowing for investment, I, and consumption, and shifting aggregate demand, left. The result is a lower price level, P, and, at least in the short run, lower real GDP. Federal Reserve actions over the past 4 decades. Though the episodes here, the Federal Reserve typically reacted to higher inflation with contractionary monetary policy and a higher interest rate, to higher unemployment with an expansionary monetary policy and a lower interest rate. Quantitative easing, or QE, is the purchase of long-term government and private mortgage-backed securities by central banks to make credit available in hopes of stimulating aggregate demand. This was used in the 2008 recession. Quantitative easing differs from traditional monetary policy in several key ways. The Fed purchasing long-term Treasury bonds rather than short-term Treasury bills. Instead of purchasing Treasury securities, the Fed also began purchasing private mortgage-backed securities.
Welcome back, everyone, to Data Science for Everyone. Today we're going to be looking at
Pitfalls for monetary policy. Banks are legally required to hold the minimum level of reserves, but no rule prohibits them from holding additional excess reserves. Excess reserves are reserves for banks hold that exceed the legally mandated limit. Volatility, the speed at which money circulates through the economy. Volatility is equal to nominal GDP divided by the money supply. Unpredictable movements and velocity. Rewrite the definition of velocity so that the money supply is on the left-hand side of the equation. This is called the basic equation of money. Money supply multiplied by velocity is equal to nominal GDP. Now recall that nominal GDP is equal to the price level, or GDP deflator, multiplied by real GDP. Money supply multiplied by velocity is equal to the price level multiplied by real GDP. Looking at this equation, we see that changes in velocity can cause problems for monetary policy. Velocity calculated using M1. Velocity is the nominal GDP divided by the money supply for a given year. We can calculate different measures of velocity by using different measures of the money supply. Velocity is calculated by using M1 money supply, has lacked a steady trend since the 1980s instead of bouncing up and down. Unemployment and inflation. Most central banks believe that the primary task of monetary policy should be to fight inflation. This vision of focusing monetary policy on a low rate of inflation is so attractive that many countries have rewritten their central banking laws since the 1990s to have their bank practice inflation targeting. Inflation targeting is a rule that the central bank is required to focus only on keeping inflation low. Economists have no final consensus on whether a central bank should be required to focus only on inflation or should have a greater discretion. In a neoclassical view, monetary policy affects only the price level, not the level of output in the economy. For example, an expansionary monetary policy causes aggregate demand to shift from the original AD0 to AD1. However, the adjustment of the economy from the original equilibrium E0 to the new equilibrium E1 represents an inflationary increase in the price level from P0 to P1, but has no effect in the long run on output or unemployment rate. In fact, no shift in aggregate demand will affect the equilibrium quantity of output of this model.
If you guys like this video, please make sure to comment, subscribe, and hit that like button, and I will see you guys next time. Bye-bye.